Good afternoon, everybody. Welcome to International Trump Circus Day. It is Tuesday, it's the 4th of April today. Yeah, we're probably not going to talk about the chaos that went on in New York City today. We're going to talk about real things, real money, real people, investment, and that sort of thing. Today's topic is going to be longer-term perspective of things, retirements, 401ks. I already got a bunch of questions from some of you for specific questions for Justin today, who, of course, is my guest. We've got Justin Krebs talking about market timing, your retirement today. That's our soup du jour, and I'm sure it'll be a lot of fun. Justin, how you doing, my friend?
Man, I'd be okay with doing the Trump circus conversation.
Oh, you want? Okay, never mind. Abrupt show change. We're gonna do. It's called a pivot. It's funny. I spent a couple hours on Friday going through this AI program I have and creating graphics saying, imagine a Trump circus in New York City with all kinds of police officers and lots of media and chaos. And the pictures that came out of there were so funny. I mean, what's interesting is I said Donald Trump and New York City and circus, and almost every picture made him like a clown with this big old red wig and face paint. I'm like, I can't use that. It makes me look way too biased. Anyway, fun stuff out there, and certainly, will be turmoil for markets the rest of the week, I think. Anyway, but longer term's more important stuff anyway. We always are under this thumb of critics that say there's no way you can time the markets, don't even bother, it's just chaos theory. But I think you and I are believers that you can time the market. So let's talk briefly about the principles of market timing and how that might relate to people's long-term investment accounts.
Yeah, I mean, it's obviously very different. Coming from where I never started long-term investing. In fact, my first experience long-term investing with my first job ended in disaster as I bought Cisco pretty much at the top before the tech bubble burst. So, I didn't really have a whole lot of, that just really soured me. But then when I actually got into trading and I learned how to do it and I learned how to time the market, then I got that complete other bias. And that other bias was like, oh, well, all these stupid, financial advisors and long-term wealth managers, they got it all wrong, right? They're just cheating their clients and all that stuff. But ever since I've kind of gotten into this world, it's honestly a balance. And it's kind of like, I equate it in a lot of different ways, but you've got to think of each different style of trading as its own true style of trading. And think of it like as a tool, right? I mean, all these investments and accounts and stuff like that, they're just tools for you to build whatever you want to build, right? So I got lots of tools in this house. I'd be an idiot if I took a sledgehammer and started to pound a nail in the wall to hang a picture. That would be dumb. That would be a poor use of the tool. And likewise, I think everybody has to keep in perspective that, like the people that I talk to on the wealth management side, right? The clients that come in, they don't really know too much about timing the market, right? So when I start to talk about that, to them about, hey, this is kind of how I do things. I'm not really afraid to take some money out, some chips off the table if the market's high. And I'm not really afraid to put more in when the market's low. That's kind of a foreign concept to them. But then when I talk to folks that from the traders world, right? Like folks that are listening probably on your show right now, they're more of like, let's time everything. Well, yeah. But you got to be a little bit different in your approach when you're talking about retirement accounts versus trading accounts, right? That's completely different, in how you do things. So I think what people have to keep in mind is an overall strategy, not necessarily the tactics, but the overall strategy for their buckets of money, if you will. That what money is you really shouldn't be trying to day trade your long-term retirement account.
Damn it.
Right? I mean, maybe you can get away with it.
No. I know better than that.
Well, I mean, let's be honest. I mean, people with normal retirement accounts just don't have the flexibility nor the options to manage it in the way that me and you understand how to do. They just don't. Mm-hmm. There's just no way. You're not gonna time the market with a 401k setup. It's what are you getting out of this mutual fund to get into that mutual fund? It doesn't work like that. So you have to kind of break it down and section off your accounts and really understand what the strategy and the goal is, and then apply that strategy and goal. So it's timing is perfectly fine on long-term accounts. It's just different than if I was day trading some, futures contracts.
Well, I'll bring up the pictures here. You can't see these, Justin, but I have the S&P going back into 1999. So back when Prince was in his heyday, going back to almost a quarter century. You have these moments where from 2001 or 2000 to 2003, the markets fell, and I'll highlight it for you guys, 50%. Right? That's the S&P 500. NASDAQ was way worse than this, but S&P is a better representation of a market. From 2007 to 2009, we fell another 57%. And I would disagree with you just on one thing. I don't usually disagree too much with everything you say, but I think you can time these retirement accounts like an IRA, like a 401k, because you don't have to go from one equity mutual fund into an equity mutual fund. You could go into a money market and just say, I'm going cash. And when you felt that there might be another move coming, and I think it's pretty obvious that based off of history, there is a big drop coming at some point. Who knows if it's this one or another decade down the road, but we'll get another 50% drop for sure at some point. Maybe there is some circuit breakers or criteria that people can put on their long-term accounts. Says, what, if this level is broken, then I'm just going to go and put it in this money market fund and stay in cash. Even though I might make 0.5% interest per year, at least I'm not going to be subject to a 50% slide or 50%, 57% slide as they have been historically. So I would argue you could go into those, but it's a little more work. I know they don't like you to be active and making a lot of trades in your retirement accounts and 401ks, but if someone is nervous about this, and the paintbrush that's being splattered on the wall right now is, doom and gloom. Seems like everyone's really freaking out about the future here. I'm not that wildly freaked out about it. I think that there's going to be some negativity in the markets, but probably not a 50% decline. But we can, to some extent, time these markets.
Yeah, and that's where kind of the balance comes in. I totally get what you're saying, right? It just, in my experience, people that have tried to time their retirement accounts do far more damage than benefit to them, because they tend to get out. They tend to get out the wrong time. They tend to get in at the wrong time. It's that fear of missing out. It's the fear of losing out. So like on the retirement side, like timing the market shouldn't be more than something that you're doing, on maybe a monthly basis. It shouldn't be something that you're spending your days looking at the market.
Oh yeah, for sure.
Messing around with. And I think that's the problem that I find with folks, right? Because if you think about it like this, the statistics hold true, right? The reality of it is that, and not necessarily a buy and hold approach, but there's been numerous reputable research papers done on this, that attempting to time the market in something like a 401k or an IRA has oftentimes, and it's the oftentimes is 80% of the time, often resulted in a much bigger loss and debt to the actual, not client, but the actual investor's detriment than it has paid off.
Right.
And so that's what I mean. Like, you have to be skilled enough to recognize not only the market turning points, but also recognize the tools that you're dealing with, right? So getting in and out of something, if you're in stocks, keep in mind the gaps, keep in mind, keep in mind the way that the market is actually going to work for you. So this is why I think having buckets of money is okay, right? Having a bucket of money that you're a little bit more willing to kind of let ride and let go. And I'm not saying buy and hold, but I've got buckets of money that I don't really even look at. I'll look at it like once a month, once a quarter, something of that nature, because I know that bucket has a particular earmark to it. And then of course I've got accounts that I trade, on a week to week basis with my options, with my option trading. And then I've got my day trading accounts, I primarily am sticking to futures nowadays. But the buckets of money have a particular purpose, and I think people can't mix them up. And that, because think about it. If you're a day trader and you also have retirement accounts, what's your inclination when you see the market heading down,
right?
Or knowing that the market's down? Maybe you're shorting on the short term. You have this inclination in the back of your mind, or this voice going, hey, you know what? Maybe I should do something about my longer term accounts, which that just may be the temporary dip in the overall upward trend, right?
Yeah, I can bring up chart after chart. One of the things that it was years ago, I was reading through some prospectuses of mutual funds, and one of the mutual funds says we're not allowed to hold any stocks that are below their 200 period moving average. And, that, again, I think that if you're shooting from the hip, kind of as Justin had pointed out, you're probably not going to do well trying to time your IRAs or 401ks or anything like that. But if you have a very structured, rule-based system as far as, okay, if this happens, I'll do this. One of the common ones is moving average. And I'll just throw it up here just as an example. To show you that it doesn't always work, but if you had been staying on this weekly S&P 500 and using the 200 period moving average, which is very long term, since it's retirement, you should be thinking long term as well. One of the simple rules is, okay, if it closes below on a weekly candle below the S&P 500 200 period moving average, then get out of your long positions, go to cash, right? Go to that money market fund or that short-term bond portfolio that your 401k offers. Well, that the last dip we had, or there were only a couple. There was one back in 2011, and then it was there for 2 weeks and then ripped back up. You see back here in 2020, when the COVID pandemic hit, it basically would have gotten you out at the market bottoms, and then it screamed back up, which would have gotten you back in about 4 weeks later. And we recently just closed below it for one candle on the 10th of October, and now it's bounced back up. So, the long term here is you certainly want to stay with the overall prevailing trend, which we are in. And using a simple strategy like that would have actually have cost you money. You would have lost money on that situation. But if the market did collapse, hindsight would have been a different story, and we would have been reading this chart very differently. So, the question we've gotten in the past is, can you time the markets? Yes, you can time the markets. The question is, what are you giving up to time those markets? You might be getting whipsawed, as this chart here with the 200 period moving average on the weekly will show you, or some other strategy, stochastics or Bollinger Bands, MACD, whatever indicators you guys want to use. Just wanted to show it on some real charts there.
Yeah. And I see some comments actually coming in. I'm actually watching the YouTube side of things, which is delayed. But, what's funny is that people are pointing out things like strategic trader. Well, great. Strategic trader is fine if you have the ability to use options.
Right.
But how many folks are actually able to be competent enough to use options? How many people that are out there? Like, think about the millions and millions of Americans that are actually out there working their butts off, raising families, trying to save for the future, and they're going to take the time to monitor their retirement accounts and using options strategies to be able to do so. That again is not just that's just not a realistic thing for most and the majority of people. And I do see Tom's comment as far as sector rotation. Okay, there is not a single study that says or shows, and I know these numbers. There's not a single study that shows sector rotation is an effective strategy for timing the market either, right? Not a single one of them. That every single market timing is, and these research papers haven't been done by these big firms. They've been done by actual independent investors and traders. And not a single research paper shows any merit to any kind of sector rotation, any kind of indicators or anything of that nature that will effectively beat the S&P. Time and time again, it's almost across the board. The S&P is going to beat any of these strategies. Mm-hmm. Now, I'm not saying that you can't beat those strategies. I'm not saying you can't beat the S&P. What I am saying is that you have to be very careful about how you attempt to do that. I think a simple option strategy, if you have the ability to use options, which a lot of folks don't have the ability to use options, a simple strategy of selling puts way out of the money is going to beat the S&P most of the time, right? So this is what I mean. People come in with this idea that they can attack their long-term retirement accounts in the same manner that they're attacking a futures trading and options trading, which that's not the same thing. We're not talking about the same thing, right? Even somebody said I think John said, I have the ability to trade options out of the Vanguard 401k. Well, great. I mean, if you can do that and you know how to do that, that's awesome, right? But how many people are going to be able to do that and understand how to do that?
Well, one of the things that gets me, and let me show real quick the graphic for people that are home. This is that sector rotation model that Justin's talking about. And what bothers me most about this one is how clear and clean cut it looks, right? It looks so predictable that, every time we have a market top, you're going to see. Well, actually, let's go blue here. Is going to be so the stock market's going to lead the economics. So you got this market top here in orange. So the market's topping. Therefore, you should start to think about looking for consumer staples and healthcare because the market's going to drop. Here's my problem with that. Those cycles always shift, but the more important thing is if the market is going down, if the S&P is going down, let's say over the next 6 months the S&P drops 25%, is there going to be one of these sectors, technology, discretionary, consumer services, industrials, materials, energy, consumer staples, healthcare, utilities, financials, or real estate, is there one of those that's going to be up 25%? Probably not, because they're all publicly traded companies. They're all listed on the exchange. So if the S&P drops 25%, sure, utilities might only be down 10%. You're still down. So I would argue that you'd have to look for an alternative investment vehicle, which Justin and I have talked about in the past, as opposed to saying, oh, I think the markets are going down. Let me jump into utilities because it's going to be better and make me more money. No, you just theoretically won't lose as much if that sector rotation model holds true. So I'm with you. I don't particularly follow the sector rotation model because I've been there too many times where you're like, oh, this sector should be next. And you load the boat on that one. All of a sudden, it underperforms and doesn't do what you think it should have done. So I really don't play too much into sector rotation models, at least from allocating capital into those subgroups.
Yeah, I mean, unfortunately, there's a lot of theories out there that don't work. I would say the majority of the theories don't work out there. I mean, just by evidence of hedge fund managers, right? I mean, again, what's the stat? Something like 90% of those still
can't beat the
underperform the S&P.
Yep.
I mean, it's just... Again, the best practice, in my opinion, is simply this. If you're going to manage your own accounts, separate them, diversify, right? Go, okay, here's the money that it has this particular purpose. If that's your long-term account and you have the knowledge to be able to time the market, find what you want to get into, right? The stocks, not mutual funds. Those are not always good, but find what you get into and be able to hedge against that with some options contracts. That's usually the best way to manage that long-term bucket if you can. If you can't do that, then you can find, like for a lot of the folks that I manage for, we have hedge strategies, right? So hedging strategies in which effectively, I know Tom said, assume that the audience is competent, but they effectively work like collars, right? So, you're getting into certain spread positions, you're selling deep into the money calls to finance that. So that gives you a situation in which you're hedged against you have a buffer to the downside, but you're going to have a cap to the upside. And that is a good way to kind of hedge against the volatility overall in the market without having to constantly getting into and out of positions. But look for alternatives. Also look for alternative. We've talked in this show about alternative investments like, private debt, private equity. If you can afford to get into them, or you can find those different areas which aren't really dependent too much on the market, which have good dividends and stuff of that nature to them, and get good growth possibilities. There's a way to diversify that without having to go through trying to time the market with a stock, right? Or trying to time the market with an ETF, something of that nature. There's ways to go about it that are less, I say, time intensive and stress intensive. So you got that bucket over there, and then you've got your kind of your mid-range buckets, which those are the buckets that you could have more active option strategies or even kind of swing trading futures or Forex contracts. And then, of course, if you have that little bucket that you want to do some day trading out of for the income side of things, great. That's how your whole portfolio should really be structured, right? But that's just what I've seen from both sides of the equation. I couldn't care less whether people hate financial advisors and think that's the wrong way to do it, or they hate day trade. I don't care. Mm-hmm. This is, to me, and I've had feet in both worlds, and this is my opinion on how I think it really is going to be done effectively if you're trying to manage your own assets. And if you don't have that interest and don't have that time and aren't skilled enough, then don't. Bite the bullet and go with the statistics of the market, the long-term statistics.
Right. Yeah. And, Tom, you're right. You can, if you apply, market timing principles or supply and demand methodology, you can find that these supply and demand zones do line up. And again, you're going to see that same basic picture. And why is that? It's because most of those segments, right, those sector funds that I just rambled off there, are going to follow the same supply and demand zones that the S&P is, right? They've generally, right? Certainly you get some market segments that are going to be slightly different. There were a couple of questions here that let me address real quick. There were a couple dealing with can I self-direct my 401k? Most employers do not allow you to self-direct your 401k. However, I would encourage all of you to go to your HR department and ask them, can I self-direct my 401k? You may be able to, but you have to understand that if you self-direct your 401k, it's a risk to the business. I had this issue at OTA. The CFO did not want to do self-directed because if you all of a sudden go out and blow your account through some stupid investment, in theory, that's kind of goes towards the treasurer. It's kind of his responsibility because he allowed you to manage this, and they put you in a select basket of mutual funds that are designed to go up over time. That's what they're built to do. Now, I say time, we're talking 100 years. Almost every mutual fund is going to go up over time. That's your market timing principle. But all of a sudden, they let you self-direct it, and you're out there, you can do all kinds of stuff with different asset classes. Maybe you are buying puts. Who knows what you can do on these things. So you might find yourself in a really bad trade where all of a sudden you've lost your retirement account. So, if you're going to self-direct, you damn well better know what you're doing. Please don't even think about self-directing if you're not familiar with how to trade. And I would say that if you have these buckets, as Justin says, one of the main things I would argue, and I am not a registered investment advisor. I did get my Series 55 many years ago, but I have no interest in being a money manager or managing people's money. If I was, one of the main things I would say is your retirement account needs to be the most conservative trading or investing that you're going to do out of all of your accounts, right? That is your nest egg. That's supposed to be the one that carries you through your quote unquote golden years or your wilted gray years, depending how you look at it. You need to be careful with that. Where I see a lot of people here saying we're using option strategies in there. Great. If you can just use options and maybe get another 1%, even if you got 1 extra percent per year, which would be extremely low risk with your options, you compound that over a long period of time, and now you're really talking about some serious money in those retirement accounts. So I think options, you should be trading options. Just make sure you use the right strategies and nothing too risky. But if you are going to self-direct, don't go hog wild. Don't start, I'm going to load up on Tesla or Apple shares. That's crazy. Do not do that. I've seen people do it in the past, and it's gut-wrenching when you hear them lose all their money. So anyway, I'm ranting. I'm on a rant.
Well, no, and I'll go a step even further in my philosophy. So I actually, if you could picture like a house, right? So the safest and most reliable part of that house is your foundation, right?
Yep.
And the one that and the part of the house that gets replaced the most is the roof, right? And then in between are the walls. So if you think about your entire portfolio, I don't care what kind of accounts you have. It doesn't matter. We can talk taxes another time. We can talk about 401ks. It doesn't matter. Your overall strategy should be, you should have money, because there's 3 things you can get out of any investment. There's growth, but the problem with growth is that you're going to have potential loss. You give up safety to get growth, right?
Yep.
You have safety, but to get safety, you give up growth. And then you have the third ball, which is liquidity, right? These 3 things I always tell folks, look, out of any investment, you can get 2 out of those 3. You're not going to get 3 out of 3 on any single investment. If you think that there's investments out there that get you 3 out of 3, somebody is selling you a ball of, some snake oil. That's the truth. So your job as your own manager is you need to have money that has growth and liquidity to it. Right now, probably 95% of what most folks have right now, stocks, mutual funds, options, all that kind of stuff, has that growth and liquidity. So you probably got that covered already. But you should also have money in assets that have some safety and growth to them. And there's assets out there like that. There's real estate, there's annuities, there's different alternative private equity investments and stuff of that nature. They have safety and they have growth, but they're not all that liquid, right? And then you have your safe and liquid bucket. Right. I mean, that's not going to you're going to give up growth, but you have some of that safe foundation, right? That's liquid and there when you need it. Everybody is a different mixture of those elements. So some of you that are sitting here going, oh, hey, you know what? I'm 40 years old. Well, probably most of your money should be in the roof, right? You shouldn't probably have a whole lot of money in the foundation. But the closer that, like, let's say your retirement's right around the corner, you should start having a lot more in the foundation, kind of that safe liquid stuff, right? So, and then the walls are just for what you really, really, really want to go after, right? It could be more alpha, building more alpha into your portfolio, or building more income as you get into retirement. It doesn't really matter. It's just everybody's going to be a different case. And anybody out there claiming and telling what anybody else should do with their own retirement is out of their mind. This is why everything needs to be custom to that individual situation, period. Because not everybody has the same risk, amount of money, and same needs.
Yep, I agree. I was over here 1 second. I was drawing some graphics to support your discussion. Unfortunately, my speaker's hiding my. There you go. I'll show this, and this is kind of the graphic that Justin was just talking about. And I think that there's a trilemma.
I actually got a slide. I could find it.
Oh, well, I just created one, but if you have one better, that's even better. So there's a trilemma in cryptocurrency we talk about where no one project can achieve everything. And I think Justin's right. When you look at kind of the allocation for a portfolio, you have growth, you have liquidity, you have safety. And obviously everybody here wants high growth, right? I'm speaking to the masses, but everybody wants high growth. Give me that, 12, 15, 18% per year from our long-term investments. Okay, in order to do that, I'm going to have to give up some safety. I can get liquidity there because obviously S&P is super liquid. But, this model here changes dramatically. And I would say that this growth portion and safety portion are the two major factors depending on your age. So, I'm working with a couple of youngsters talking about personal investing. They're in their 30s. Well, they can focus on growth and go for the real volatile stuff because they've got time. But somebody like I don't know, someone who's in their old and during retirement or in retirement, you're no longer thinking of growth. It's capital preservation. So this growth pie shrinks down dramatically, and you're focusing much more on safety and the right investment so you don't get burned. Anyway, I had to create that graphic there, Justin. Hopefully that I did it some justice there. It's hard to do it live.
No, that's great. It's exactly, and you're exactly right too. I mean, and by the way, even if you get older, let's say you have a pension, Social Security that's going to take care of all your expenses. I mean, you are free to have a as large of a growth piece as you want because you don't technically need to dip into the growth piece, right? Yeah. So that's just another little element that comes into play as well. So
nice, I like it. Lori, there you go. If you're like Lori, if you're like Lori and retired, there you go. That Lori helped me out with that one.
Lori's old and retired.
That's just it. All right, let me see. I had a few questions here. Let me run through a couple questions that came through some of the viewers, and we'll see if we can dive through these. How much time we got? All right, I'll try to rip through these. What does Justin think about borrowing money from a 401k so you can trade futures? That's from Skilled Stocksman, who's here. Prepare to get grilled, Skilled Stocksman. What do you think, Justin? Take money from your 401k?
I've got a very long explanation for this. No.
Can you break it down to one letter? Because two is just too much.
I don't even need a letter.
you can do the what was his name, Akeem Olajuwon, where he just waved his finger. Nothing in my house.
now, by the way, I also understand where that comes from.
Yep.
I do understand where that comes from, but I would not encourage you to do that just because I've seen it not work more times than I've seen it work.
I mean, I just made that conversation piece about, you that retirement bucket needs to be in safe things. And now you're saying, we go into the futures, now using leverage instruments, and God knows what markets you're trading have insane volatility. I personally would say no as well. Of course, you can do whatever you want if you have that ability in those retirement accounts, but it's just not worth the risk. And for me, I take my retirement accounts, the long-term stuff, it sits over there. I'm doing my best to generate as safe as possible, getting extra rates of return using options, but I'm not going to be trading futures in those accounts at all. Never would even cross my mind. All right, question number 2. Let me go. It's always awkward. This thing's hiding behind the screen here. Let's see. My grandfather has a family trust. What is a family trust? Is it life insurance? That's from Glenn. What do you think? We talked about trust a few weeks back, which in my mind are an amazing vehicle for people, especially from a tax perspective and just keeping your family sane. What about a family trust?
I mean, a family trust is, again, all trusts. When you talk about a trust, it's a vehicle to. It's more about distribution, right? So a revocable trust, such as a living trust, which a hybrid of that is obviously the family trust, it's just about distribution. Should you be incapacitated or die or whatever that may be, it's about avoiding probate. Essentially, is what a trust is always about. Now, irrevocable trust, that's about avoiding estate taxes as well. But you can't control the money in an irrevocable trust. So a family trust, a revocable. Something like a revocable trust just includes components for the family and how it's distributed, amongst the family, right?
Yep.
Those are obviously one of the things that I encourage all my clients to do, and I would encourage anybody out there, is to organize your estate. Have a conversation with somebody knowledgeable about these things. Like, most of your 99.9% of your advisors aren't going to be knowledgeable about it. But if you know an estate attorney or something of that nature, have that conversation with them. They're going to push you towards wills. And I understand why they push you towards wills, but wills do not they tell you about the distribution of your assets, but a will always, you're going to land you in probate. A trust allows the distribution of assets without probate. So it's not insurance, but it's just allowing for a steady distribution of all that money that you worked so hard for after you pass away.
All right, there you go. Perfecto. Let's see. This was a long one here for me to read, so let me pop this up on the screen here, and it was a lengthy one. It's funny because it actually came down to one question at the end. This is from Tom. He says, present how a Roth IRA works for the vast majority of people. The average American pays 13.6% in federal tax while working and 5.7% tax when retired. For the examples given by Justin and others selling wealth management services, there is always the assumption that income will go up in retirement, even though the average person has less than $100K in retirement accounts and less than $200K in total net worth. What percentage of people see their income and taxes go up in retirement?
So that's a good question, but the problem is that, Tom, we're talking about completely different demographics here. The folks that seek me out, they have assets in which they need to be managed. So if you're talking about the average American or less than the average, the average American that has less than a certain amount of savings in an account, then yeah, you're absolutely right. You're going to see an increase in taxes. Most likely not, because if you just have Social Security and you have a very tiny savings account, then chances are you're not going to have any kind of tax bomb. Even though you may face tax consequences if taxes go up, you're not going to really have a tax bomb. But for the folks that you start to get into that 500, 700,000, certainly in the $1 million range and above there, you're going to have a tax problem. Your income's going to go up, and here's why. Is because all those probably 90% of that, and the statistics are 91% of American savings are in tax-deferred assets, meaning that is not forgiven tax. That is tax that is going to be taken out of your account when you hit the right old age of, it used to be 72, now 73. And the IRS is going to mandatorily make you take it out. And it starts around 4%. 4% of $2 million is $80,000, and that's pure income. And that's going to be on top of your Social Security and your pensions, whatever you're doing. So here's the thing. 95% of the folks that I work with are going to be in the same tax bracket or higher when they retire, because honestly, they don't want to reduce their living, especially in the first 10 to 15 years of retirement. They're not cutting back on going to dinners and stuff like that. That's the old way of thinking about retirement, where your father or grandfather, that's what they did. They cut back on expenses. But they had pensions. They had, Social Security went a lot longer, a lot bigger, a lot longer for them. The baby boomer generation, they're very different. They want to maintain their standard of living. They want to travel. They want to visit the grandkids. They want to give gifts to their kids and grandkids. All that kind of stuff goes on. They maintain that same level of income as when they were working, usually. So that income's got to come from somewhere, and 90% of that money is sitting in an IRA somewhere. You take it out, that's fully taxable. And in 2026, when all those Trump tax cuts expire and you bump up in tax bracket, you bump 3% higher in tax bracket, and the estate forgiveness level comes down as well, that's the thing, right? You're going to have higher taxation. So that's why I'm such a big fan of saying to the folks that have stored their money in tax-deferred assets, get rid of the liability now. Not only is it going to save you significant amount of taxes in your lifetime, even if taxes don't change. But it also helps buffer and mitigate any issues of when taxes go up. Because if you're thinking $181 trillion of unfunded liabilities isn't going to result in higher taxes for us as a country, I don't know what to tell you. They're going to come for it. And the largest source of untapped taxes is on those tax deferred vehicles. Yeah. So this is why I would rather remove that from the equation than not remove that from the equation. Because why have any risk and liability out there? It's just another risk when you talk about your portfolio. So, but yeah, you're right. If you're talking about someone who doesn't have a whole lot, then tax doesn't really filter into the conversation. If the majority of their, if 90% or 100% of their income coming in is Social Security, yeah, I mean,
no big deal.
What are you going to say about that?
Yeah, but I think, yeah, Tom, I don't know Tom's numbers. I don't know how accurate those are. Tom's usually very good with numbers, so I'll assume they are. But you know, I know most of the people that I know have more than $100,000 saved, and definitely more than $200,000 worth of assets. So it's definitely going to vary from person to person. But if you're somebody who does have a lot of money even saving, I think it's absolutely something you have to consider. You know, you're probably going to start paying a lot more money. So the strategies to not prevent, but to deal with that in the future should be dealt and planned now, right? You start planning for these things now and saying, okay, how can I start to structure this so when I do get to that point where I'm forced to take money out of different accounts, and this happens here and there, how can I reduce that exposure? Because what we all would love to do is give as little money as humanly possible to the government within the tax code and the tax law, right? You want to give more, Justin? I see you shaking your head over there.
Well, I just saw the comment by Tom.
Oh.
And that's, be real straight with you, Tom. It's not a disingenuous sales pitch. Nobody makes any money off of Roth conversions. It is simply doing what's best for the majority of folks. And if you actually did the math and the statistics and look at all the research, converting into a tax-free situation is going to benefit you in about 85% of the situation, 86% of the situations. And that's not even that, and that's just taking into account taxes go up, down, sideways. There's research done on this, so it's not disingenuous. It's not a sales pitch.
There you go. Yeah. No, and I've seen the math before, and I switching over or going into a tax-free situation again, depending on where we are at, makes a lot of sense. So anyway, well, I'm gonna start to let's wrap things up here. I got other things I want to get to. I got to run through our market and talk about Trump. You know that.
Oh, who doesn't want to talk about Trump?
No, I don't want to talk about Trump at all. All right, well, I'm going to put your proactiveinvestor.com site up here. I keep trying to get you to social media, but I know it's difficult for you to go to social media. Do you do any other events, any classes, any things like that?
No. I mean, I do some local events and whatnot, but that's I just do this to kind of get me out in the wilderness.
I appreciate it. I like to look at things from different perspectives every now and again. Guys, it's theproactiveinvestor.com if you want to talk to Justin or get some ideas about your portfolio and some of the topics that he's discussed in the past. If you look at the archives, there's a whole bunch of other videos that we've talked about, taxation and different retirement vehicles, alternative investment vehicles, etc. So good stuff. All right, my friend. Well, thank you very much. I appreciate you coming on as always and sharing some insights into these markets and kind of what to think about for the long haul. So thank you very much.
Appreciate it, buddy. Thanks for having me on.
Thank you. Take care.
Bye.
All right, guys. That was Justin Krebs talking about a little bit about market timing. And I thought it was interesting that he thought, well, market timing in your 401k, certainly I don't think he's going to recommend that because I think that there is a little bit too much risk to the average person that doesn't know what they're doing. I, for one, do think that there are principles to market timing. We've had this conversation in the past, certainly on the TraderMerlin or the Power Trading Radio Show years ago. And that was to the extent of people believe that markets only go up over time. And the charts that I've shown, there is a very clear pattern that over the course of time, we get these big market sell-offs. We get these huge 20%, 50% drops in price. And like, oh man, it would have been nice if I sidestepped that. And if you just do the math and let's say a market falls 50%, but you're not going to sidestep the whole thing. Let's say you get out of a position because it dropped below a 20-period moving average or 50-period moving average, some indicator. And market falls 50%, but you sidestep 30% of that. Well, now all of a sudden you can buy back in at much lower prices, and therefore your rate of return will increase over time. So I'm definitely a believer in market timing. I definitely think you shouldn't be taking big chances by going into risky assets. I think staying in ETFs on the broader scale, index ETFs as typical like S&P, Dow, Russell, NASDAQ, those types, or even those sector ones, if you are, like Tom mentioned, finding good supplier demand zones, or you feel this sector might be hot right now, as we've seen some sectors really ripping up, others having some struggles here, that can also increase your rate of return using market timing and sector rotation. Let's see, what else do we have here? Cool. So again, that was the proactiveinvestor.com. I will put that link in the chat for you guys so you can have that one if you want to discuss anything with Justin. And then let's dive into the show that happened today. Well, I'm not going to go and talk about Trump because I really don't care. I think it's a stupid soap opera, and it doesn't bother me either way. Here is our market. I will get that line off. I'm going to start at the bottom, work our way to the top. Russell 2000, that canary in the coal mine, dipped again today. This is the weekly time frame, so I'll zip out here and go into the daily time frame, which I like to start on. And yesterday, well, nice. It came right down the moving average here and up to the moving average and bounced down, but pretty much erased the last 2 days worth of gains in one day. You had a 1.84% slide today for the Russell 2000, bringing it to 1780. S&P 500 faring not as bad, down 0.6%. We talked about it coming up in overhead supply and also hitting that downtrending line that connects those peaks that goes back into August of last year. And there you see a nice little red candle forming today. So we'll see tomorrow if momentum actually carries this back down. Who knows? Maybe that 40-40 line becomes a challenge point or a retracement point. That's that area of what was supply now will become demand on that breakout. That's your S&P, which is at 4129. Dow was pretty much the same, 0.62%. We had drawn multiple level on top of levels here for supply. It didn't even hesitate at the lower one. Now you saw a little bit of reversal at the upper one. Again, same picture here. We'll see what it looks like tomorrow if we get that follow through from today's kind of negative tone. NASDAQ 100 was down much more than this today, but only finishing down 0.38%. 13,219 is your final number. You had the Harami formation yesterday, bearish Harami. You have not really a shooting star, but no closing high today. So again, I really feel like you should be putting lines across these lows of the low from today, which is right around 13,173. If we can drift down below that, start building your short positions and see if we don't get a pullback that goes much deeper than that. All right, top three. Bitcoin, 0.39%. Nothing to speak of here. It's still stuck in the range. The good news is it's traversing sideways and staying in that yellow box. I'm hoping it breaks above 2,900 or 29,000 here, which the longer it stays in the sideways channel, the more likely it will break to the upside. Crude oil. Another up day, but this one is not a jumper. There's only 0.36% gain today for crude oil, which was a spinning top formation, very similar to what we saw yesterday. Long tails on bottom and top, pretty much unchanged for the session. Hesitation near the end of that range, which we've mapped up there with that yellow box. And finally, Skilled Stocksman's favorite trade of the day. We talked about this pennant formation, almost a bullish flag formation on gold, and today we broke through it. Hallelujah, hallelujah. Now the question will be, where do we go? So, typically on a flag formation, and I'm going to do this one time and one time only so I can get rid of this. This is a hideous looking flag formation in my opinion. The measuring object here is this vertical, kind of diagonal looking blue line. So since we broke out today, I'm going to put that right on the breakout price, which is right there. And I'm going to get rid of this so now I don't feel stupid for having such bad artwork on my screen. And that will be your target expectation. Now, where is that? I'm sure that since Skilled Stocksman is long on gold right now, you'd be loving this. That's going to forecast a price of roughly $2,228 for gold. That would be your peak out there. That's actually a gain of about 11%, which I really don't think that would be that far. That's from the breakout point. From where we are today, it's only another 9%. So, that's not a unlikely scenario to see gold not only reach that level, but also in the process, when I look at a monthly here, set your all-time high. So gold looking very good. Some would argue that this is a giant cup and handle formation popping to the upside here. So all looking very nice on this gold chart to the upside. That is the major stuff out there today. Let me go real quickly and show you a couple other pieces. That dollar index, and I think to Skilled Stocksman's point, he's like, well, kind of what's going on with this dollar here? Well, we talked about this 2 weeks ago. That's why this yellow box is drawn there. It says most likely you're going to see this thing come back down to that 101 line and get back into this demand zone, which was there. I would say it's eroded now. But this was kind of that target that we had for it, and said if we keep drifting down to that dollar, you're going to see commodity markets start to do rather well. And check out silver. I'm kicking myself for selling the 2150 calls on silver because we hit $23 today. I'm like, son of a biscuit. I would love to have had an extra $1.50 on my 2,800 shares of silver, but oh well, it is what it is. We'll just leave it. Peter Schiff would be a happy man today. Yeah, I'm sure he would be. I'm sure he is. I'm sure he's taking every moment to get on news and talk about gold today and why it's the greatest thing in the world. This is the one thing that bugs me about Peter Schiff is he is so pro gold and so anti everything else, and he's such a like not willing to listen to anything else. It's just these blinders of gold, 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 gold. And I think that I don't know. I don't think that will serve you well over time. But anyway, gold looking great out there today. Nice pop, and a large part of that happening because the dollar just keeps on drifting. Right, the lower the dollar gets, and the commodities that are priced in U.S. dollars, foreign entities can buy more of that commodity because the dollar is so cheap. So looking really good there. The question now is, are you going to see a bounce? Right? Does this 101 level hold for gold, or sorry, for the dollar index, or do we see it break down and maybe get towards that 100 mark? Well, we'll see here in the next couple days. Right now, dollar certainly looking weaker and weaker, which is paying dividends for anybody who's long on some of these other indexes. Like, here's the euro, which has been on a beautiful uptrend, going to 110. Looks like your next stop on the euro. You also had USD JPY. Actually, it's the opposite. Let's go to Aussie dollar. Right, so Aussie dollar, even with their rate announcement that they did last night, last night? Yeah, last night at just after midnight. Still not the greatest day. They're only up 0.03% in the new session, but you kind of would expected there to be a stronger move up, and they kept the rates right where it's at. New Zealand, which I don't have on here, NZD, USD, they come out with with their rate hike tonight. I believe they're expected to raise another 25 basis points, which I'll show you that calendar here in just a second. Yeah. So let me go through here and show you the economic calendar for tomorrow so I can wrap some things up here. This is for the 5th of April. We have services and manufacturing numbers for pretty much all over the world. You can see we have, where's the rate announcement? I think that may have actually been for today. One second. Let me scroll back and look at something here real quick because I want to show you today's, because we do have other data coming in here, and there it is. So come on. There it is. So yeah, your rate announcement, expected to go from, here we go, 4.75 up to 5%. That's going to happen in just a couple of hours. And then after that, then we can go to our calendar here, which is the current information on your screen for the 5th of April. And that is going to be lots of manufacturing and services. You can see starting the wee hours of the morning, they're like in 30-minute intervals. Here's euro, and then the British pound, and you have Germany and France reporting independently. You have Canada reporting, and then all of a sudden the U.S. reporting services and manufacturing numbers as well. Crude oil inventory is also coming out tomorrow, which, of course, given the way that crude oil has gone lately, we'll see how those numbers come out because price has been ripping. But the big news is going to happen an hour and 15 minutes before the markets open, and that is the ADP, non-farm employment change, which goes from 242, they're expecting 208, so expecting those job numbers to decline a little bit, but we'll see if that market is still hot. Some of the JOLTS job openings numbers did not come out as great either. So that is your economic calendar. There is no real earnings calendar to speak of for tomorrow, so that's going to be it. Tomorrow, today's Tuesday, right? It's Tuesday, so I got Wednesday, I got Thursday. I'm going to take Friday off just because it's Good Friday. I may as well go enjoy some sunshine for Good Friday. So I'm going to take Friday off, which means I will have whiskey for you guys on Thursday. And I'm going to see if I can get Sam Evans on the program. He was talking about coming on this week. I'll reach out to him after the show today and see if I can get him on the program. Talk about hedge funds. This new endeavor, he's running a hedge fund. So see what that entails, what that means, what that model look like. If you guys have questions, comments, feedback, let me know. You can email me at TraderMerlin@gmail.com. It's on the screen right now. Or you can put them down below any YouTube video. I generally write down all of them on the YouTube video into the PowerPoint and get those questions answered for you as soon as I can. So that's going to do it for today. I hope you guys enjoyed something. No market, no show. That's right, Rajesh. I mean, I could have done a show, but I'm going to take a Friday off and enjoy it. I'm going to probably take my dog out to the beach or maybe the mountains. It's funny, I went to Newport Beach, or Huntington Beach this weekend, and I was riding electric bikes on the strip, and we look over to the right, and we see this beautiful beach, right? Gorgeous, a little windy, but nice beach. And then I looked to the left, and I could see the mountains, and the mountains all had snow on them. One of the only places on earth that you can look, and within a couple hours I'm in the snow. In 10 minutes, 5 minutes, I would be sitting on the beach. The beauty of living out here in California. I'll write some comments after the live show, too. Merlin gives, well, I try, John. It's fun. It's a one venue where I can just talk the way I want to talk and not be governed and say the things that people want me to say. So I do enjoy doing the show. Anyway, yeah, hit that like button. Hope you guys enjoyed it today. Again, if you have feedback or comments, let me know. It's TraderMerlin@gmail.com or any other YouTube video. I'm going to go for the second walk for the day with my big old dog. I will see you guys tomorrow. Take care, everybody.